Analysing and researching a potential investment is essential to managing our risk as investors. We must carry out our due diligence to protect our capital as much as possible and, better still, maximise our returns. All of you will do this to one extent or another, but we're always looking to improve as investors, learn new skills and ways to manage our portfolio. And today we'll be going through some of the key concepts to look at when analysing a potential dividend stock. The metrics we'll be discussing relate to the underlying stock itself, but mostly around the dividends. So if you're looking at investing in stocks that pay out dividends to shareholders to earn a growing and sustainable passive income over time, then this video is for you. Welcome to Wise Wealth, and without further ado, let's get into it. The first thing to assess when looking at a stock that pays a dividend is how reliable that dividend is. It's all well and good if a stock price has fallen to a point where it advertises a dividend yield of 10%, but how sustainable is that? How long can the company keep paying such a high dividend before it has to cut or even suspend the dividend entirely? There's no point investing in a company for passive income if that income is not frequent and consistent. Although dividends are never guaranteed, we can study the track record of companies to give us an indication of whether future dividends will be paid out. To find this out, I use Dividendmaxcom. Their website is intuitive and simple to use. Here I can type the name of a company I'm looking to invest in, or the ticker symbol to obtain an all-encompassing view of their dividends and a track record. In this example, I've searched for Johnson & Johnson, where I can see a current dividend yield of 2.6%. Not particularly high, but outpaces the S&P average yield. What is more impressive is the consistent track record J&J has shown of both paying and growing the dividend over the lifetime of the company. Below, I can see the dividend growth in a percent figure to give me an idea of how much my passive income stream will grow over time. This is not a sponsored video, I just think that the website is very useful, so be sure to give it a try when looking at your next potential stock. I've left a link to it in the description below. For a more comprehensive site that provides high quality charting and metrics, I would also recommend Morningstar.com. On the subject of reliability, another metric to look out for is the payout ratio. This is a metric used to show the dividend paid compared to the company's profits and can inform you as an investor if the company is suitably able to service the current dividend with the profit it's making. This is typically expressed as a percentage. A high payout ratio indicates that the dividend paid is near the level of net income and could call into question dividend sustainability. What's more important is how the payout ratio is trending. A steadily rising payout ratio can indicate a maturing company where share prices are unlikely to appreciate rapidly. However, a spiking payout ratio could mean that the dividend is heading into unsustainable territory. If a company's payout ratio exceeds 100%, it is returning more money to shareholders than it is earning and will probably be forced to lower the dividend or stop paying it altogether. This is not a guarantee, as was the case with many companies during the stock market crash of 2020. Take this example comparing Unilever and Microsoft. Both are dividend-paying companies that consistently grow their dividend. Unilever pays a great dividend of 3.86%, while Microsoft has a more conservative yield of 0.76%, focusing more on growth and share capital appreciation. At first glance, you might think Unilever is the best bet, but the current dividend sits at a payout ratio of 82%, higher than its 5-year average of 65%. On the other hand, Microsoft's payout ratio is only 28%. If Unilever's margins become squeezed as inflationary pressures persist, then Unilever may be faced with the difficult decision of either taking on debt to continue their track record or cut it entirely. Companies with such a long streak of growing their dividend are extremely reluctant to cut them since it can drive the share price down and reflect poorly on management's abilities. Microsoft, on the other hand, has ample room to continue to grow its dividend and service it through net income. Its 3-year dividend growth is a staggering 31.45%, meaning investors won't be left with a low dividend for very long. If you flip the payout ratio around, you are also able to calculate the dividend cover, effectively showing you how many times the income of the company can cover the dividend payment. A high dividend cover, or a low payout ratio, indicates more room for potential dividend growth. So logically, we want to look for companies that can maximize their net income as much as possible to provide room for substantial dividend growth that we as passive income investors can benefit from. Take Segro as an example for this. The company pays a modest dividend of 1.9%, while having an extraordinary dividend cover of 5.62. Not only does the company have room to grow the dividend as it is, but the fundamentals for industrial real estate owners provide further growth in the future. With a shortage of warehousing in the UK and ever-increasing demand by occupiers, rental growth and further progress in development pipelines will allow Segro to grow its top and bottom line, providing a strong backdrop for shareholders to receive a substantial and growing dividend. The pandemic led to a surge in online e-commerce and the need for distribution warehouses and fulfillment centers, and Segro, as the owner and operator of these properties, was the beneficiary. Currently, the stock is up 37% from its March 2020 low. I've already done a full stock analysis on Segro, so if you want to check that out, I'll leave a link in the description below or click on the banner in the top right hand corner to go there. Another point to look out for is how does the yield compare relative to historic 12-month trailing yields. This compares what the stock costs relative to other times in the past and can signal a few things to us. Firstly, it can tell us if the stock is richly valued compared to the past. With stock markets near all-time highs, you won't be surprised to find this the case for many dividend stocks. Take a look at the dividend yield over time for Walmart, a company with a 45-year track record for consecutive dividend increases. With a current yield of 1.58%, the stock doesn't pay a healthy dividend as it has in the past, suggesting investors have to pay a higher premium for a stable yield. On the other hand, if the dividend yield is drastically higher than the past, it may indicate a potential cut or suspension. Shell was the perfect example of this back in 2020. In the wake of the pandemic and the crash in demand for oil, the company was forced to slash its dividend by 66%, the first time since World War II. A higher yield relative to the past can signal opportunity, or it could be a sign to steer clear. Another factor to consider when researching a potential investment is relative valuation compared to industry peers. A company might offer an attractive dividend and solid growth prospects, but what good is that if there are 4 other alternatives in the same industry? Comparing your stock to its competitors can tell you if it's fairly valued. If it's significantly cheaper, why is that? Does the market not feel that the company can deliver on its growth targets, or is it simply undervalued? If it trades at a premium to its competitors, does it have a unique offering that sets it apart? Are its future cash flows guaranteed by a wide economic moat? Or is it simply a flavor of the month stock that is due to re-rate lower? Let's take a look at a few examples by comparing the UK supermarkets. Recently, Morrisons was auctioned in a bidding war between 2 US private equity companies. The FTSE 250 listed supermarket was successfully won at auction by Clayton, Dubilier and Rice for 287 pence per share, beating rival bidder Fortress, who offered 286 pence per share. What is most interesting about the closing price is that it represents a staggering 61% premium to the share price back in June when the initial bid was brought forward. The final bid raised Morrisons' price to earnings ratio to 47.97, which poses the question: are UK supermarket stocks undervalued? The answer to the question could very well be yes. Since the bidding war began, shares in both Sainsbury and Tesco have gained in sympathy, up 16.5% and 19.6% respectively. However, they both remain markedly cheaper than the premium paid by CD&R. Tesco trades at a PE multiple of 23, while Sainsbury trades at 25, implying both could be inefficiently priced if Morrisons was considered a fair reflection of the true value of UK supermarkets. It was said that the real estate owned by Morrisons was at the heart of the bidding war. Tesco and Sainsbury are both sizable property investors in their own rights. Sainsbury is said to be working with a boutique investment bank to help defend itself from a potential takeover in the wake of the Morrisons acquisition. With a current market cap of £6.89 billion, it is freakishly close to the £7 billion bid that it took for Morrisons to be auctioned. With a market cap of over £21 billion, Tesco should not face the same concerns. And with a lower PE multiple relative to its peers and a dividend yield of 3.63%, the stock appears quite attractive at its current levels. So those were my top tips for what to look at when analysing a potential dividend stock investment. If you got value out of this video, make sure to give it a like down below and consider subscribing to WiseWealth for more personal finance and investing content. Thanks for watching, and until next time, see ya.